Hello, good afternoon, and thank you so much for joining our webinar today. Make that cash flow for your business in 2023. Today's presentation will be led by Wendy Roberts. Wendy prides herself on creating winning strategies while helping her customers maximize their resources and their profits. As a CPA, she knows her way around corporate financials. As an entrepreneur, startup CFO, and CVO for North Star Strategic Partners, and a former corporate financial, Wendy offers a broad insight into finding solutions to help her customers achieve exceptional growth and financial success. She has a bachelor's degree in accounting from Indiana University, MBA courses at the University of Tampa, and years of experience counseling customers on financial and profitable success. Wendy is originally from the Midwest and was raised in a working class family. One of her most favorite and cherished hobbies is cycling. She never fails to miss a weekend cycling in the Bay Area and taking in the panoramic views. So enjoy and let's hear it from Wendy.
Thank you, Shai. And thank you to all of you who are joining on our webcast today. It's that time of year, it's year end. We need to start thinking about year end tax planning as well as what's coming forward in 2023. We're in some interesting times right now with inflation and where our economy is going, but things look to be on the up and up. And I do think we'll have a great 2023 towards the end of the 2023 year. Today, I wanted to talk to you about how do you cash flow your business? What things should you be looking for in order to be able to create more cash, therefore more profitability, especially on your bottom line? So first, I want to talk a little bit about the basics, and that is your financial statements. So for those of you who use QuickBooks Online, or Xero, or FreshBooks, it's all the same types of financial statements. So they tell a story. They tell where you have been and where you are at this point in time and where you have the capability of going. And that's what we'll talk about here in the next few slides and how we can help you create more cash. So first, let's talk about the balance sheet. All right, the balance sheet, as you see here in the middle, is the assets, liabilities, and equity. The balance sheet has assets, which are things you own, liabilities, which are things you owe, and what is left over between the two is equity, or your capital. When you think about it, a balance sheet is a snapshot at a point in time. And that's important to remember. It's a point in time. The second thing to know about a financial statement is the income statement, or known as the profit and loss. So this tells you how profitable your business is over a period of time. So if you notice up in the upper right-hand corner, we have an income statement that's revenue less what you expense to run your business, and the difference is profit. And then the next statement, I think, is probably the most important one. And for a lot of business owners, they don't pay much attention to it, but it really is something that I recommend all of our customers and the clients that we work with to really pay attention to it. We do a lot of analysis around it. It's called the cash flow statement. And it's the net cash that moves in and out of your business during a particular period of time. Now, that's very important because it tells me as a reader of the financial statement, whether I might be an investor or a banker, how well you manage your cash. And that's going to be really important as we talk about cash flow going forward. Now, positive cash flow indicates a business that has more money moving in than moving out. Again, that's significant as we start scaling the business. Now, I'm not going to try to make you an accountant or CPA. That's what we do. But what I am trying to do is helping you be a better business owner and a better CEO. So let's talk a little bit about cash flow, right? And why is it important? We actually have a methodology that we call the Profit First methodology. It's from a book called Profit First by Michael Michalowicz. And it is a way to look at how to manage your cash. So we are a big proponent of that. It's a little bit way of looking differently about how to manage cash flow, but it really does work. We have clients that are on the Profit First methodology, and we've had some great returns. Now let's talk about profitability. So profitability tells you where you're headed, and if you're headed in the right direction. It's a value creation. So the more profitable your business is, especially when we're talking about net profit, the more value your company is driving. So the higher the value, the more attractive that is to a person that might want to buy your company in the future. Second, when you calculate your revenue, you're looking at how much of that revenue and the expenses that are used to generate that revenue. That's also a component of cash flow. Another area of our cash flow methodology that we use is the process of creating cash. How do you create that cash? Who's your ideal customer? How do you attract that customer? And what does it cost you to do it? And then the fourth one is you can survive longer periods of time with a positive cash flow. It's that emergency fund, or another way to look at it as a celebration fund. That's so that in times like this, where we're challenged with potential supply chain issues or higher prices, you have the ability to be sustainable over a period of time. So now let's also look at cash flow from a cash flow perspective. So when you have a positive cash flow, it tells you what it takes in order to get there. So in other words, you as that business owner, you have ups and downs. We all do. But when you find a formula that's working, you want to stick to it. So it's the discipline. How do you save during the good times for those times that it might not be so good? Another way cash flow does is it measures what went into and out of the bank. Remember, I talked to you about the cash flow statement. That's very, very important. When we talk about cash flow forecasting and Profit First, it is that way to manage cash from a banking account standpoint. Number 3 is the source is material for the profit. Is your business a cash spigot or is it a cash drain? We're going to talk about some ratios here in just a minute, but I want you to think about one thing. When there's a lack of cash, it leads to a very swift demise. Without cash, we all know cash is king. Without cash, you cannot survive in business. So now that you know a little bit about financial statements and how they interrelate and about cash forecasting and cash flow, why it's important, let's talk a little bit about ratios and why that's important to you as a business owner, to a banker, to a buyer, to an acquirer, perhaps with a strategic buy. All of these 3 ratios we teach as part of our methodology that we call the 4 points of focus. Okay, so let's talk about the first one, working capital ratio. This is also known as the current ratio. It measures the ability of a company to meet its obligations. It's also a way to measure liquidity. So if you pull out your balance sheet, now this is on your balance sheet, okay? Remember the balance sheet being the assets, liability, and what's left over is capital or equity. So that formula, you may want to write this down. And when you go look at your P&Ls and your balance sheet and your QuickBooks, I want you to run this ratio, okay? So it's total current assets divided by total current liabilities. Now, let me give you an example. Let's say we had $100,000 of assets, total current assets, and $100,000 of total current liabilities. That is a 1-to-1 ratio. In other words, it's a break even. A ratio that is less than 1 is not good. That means that you're burning more cash. Your liquidity is at jeopardy. You will probably never, ever get a bank loan, nor are you going to have a buyer that's interested in you. However, if you have a current ratio of 3-to-1, 4-to-1, meaning that I have $400,000 of total current assets divided by $100,000 of total current liabilities, I have a ratio of 4-to-1, meaning that you are 4 times have more assets than you do in liabilities. You're more than capable of meeting your obligations. You would be very attractive to a banker because the banker wants to know, do you have the ability to repay that debt with interest? Because that's what they're in the business for. And for a buyer of your company, now it doesn't matter whether you're going to be selling a year from now, 5 years from now, 10 years from now, you should always have it in the mind of how you run your business. The more efficient you run it, the more valuable it's going to be. With a ratio of 4-to-1, the buyer is going to say, oh, I'm going to get my investment back, my return on my investment, quicker and in better shape than if someone were 2-to-1. The next ratio is called the gross profit margin. And for you, those of you who are in the construction, the trades, interior design, any of you that have project-based types of income, this is very, very important. The higher your gross profit margin, the more profitable you are. The better you are at managing your cost of sales or the expenses that go into generating that revenue, the more you are better at managing everything below that to pay all of your expenses. So I know it sounds a little complicated, but gross profit margin is your gross profit, which is your revenue minus your cost of sales, divided by your total revenue. So again, the higher that percentage, the more you are able to meet all your other obligations for the business. So let's say, for example, you are a software company. 60 to 65% is a very acceptable gross profit margin. Also, if you're in construction, you want to be getting at least 35 to 40% on your projects. So therefore, if you're not getting that, you really need to take a look at what is causing you not to drive that 35 to 40%. Again, is a gross profit margin per job and gross profit margin overall. The last one, which then goes back to our profitability and cash flow, is the net profit margin, which shows you how each dollar that you've generated is able to translate to profit after you paid all your expenses, including yourself. What's left over is either a single digit net profit margin, which is not good, or double digit. So the higher that net profit margin, the more valuable your company, the more attractive it's going to be. So let's talk about, why do we track these 3 ratios? Why does it matter? And I think I kind of alluded to that already. But the ratios help you measure the strength of your business. Just these 3. Now, there are several others that we work with on our customers with, but these 3 are the very basic foundations that you should be tracking every single month. And why it matters is if, again, you're trying to get, let's say, a loan to expand, or if you are thinking about selling in a couple of years, now's the time to start planning for that, to increase that net profit margin, to increase that current ratio, so that you look very attractive to someone to want to invest in you, whether it's a bank or a buyer. Think about it like this. You usually have, as a business owner, we usually have two really big assets in our portfolio, and maybe a third. But the first one would be your house, in which you put money into that for renovation. The second might be your 401k or retirement plans. And the third is your business. Why not put effort into making sure you get the maximum amount of value out of your business? You're spending 40, 50, 60 hours a week working on your business. Why would you not want to put in that energy? These three key ratios you can monitor every single month. It tells you the health of your company. Now, let's switch to why someone would want to do cash forecasting or budgeting. Now, this is part of a cash flow methodology. First, we talked about looking at the financial statements and why they're important. Then we talked about ratios and why we want to pay attention to them. The next is budgeting or cash forecasting. When I talk to many business owners about coming to work with North Star, I am surprised that the majority of them do not have their books in order and they do not know how to manage cash flow using cash flow methodologies, such as over a period of time, such as 12 months. We usually do 12 months, sometimes a little bit longer, but those 12 months we then put into a monthly forecast. So we project out the revenue for the year and the expenses. Then we allocate on a monthly basis. Now, it's not necessarily going to be 1/12 because some businesses have higher months and lower months. For example, real estate or construction because of the weather and other avenues, right? Sometimes for a mover, it might be the summer because more people move during the summer than they do in December and January and February. So depending on your business, we would want to then allocate more revenue to the higher months, more expenses to those higher months, and when you're not as busy, lower revenue. So it's a matter of adjusting. Now you might say, okay, if I'm able to prepare for these unpredictable life changes and be able to afford big ticket items, then you have to think about what would be some of the ways in order to manage that cash and your budget. So in other words, helping you go through that process, really thinking through what does it mean, and then recording that on a monthly basis. And then once we have that, then we would be using your QuickBooks or Xero, or FreshBooks, whatever accounting system you use. We would then record your actual expenses and then measure the budget to the actual. And whatever the difference is, then we would be sitting down and analyzing, why did we go over budget? Our forecast, why did we go under? So when you think about all of the things that we've talked about, financial statements, why are they important? Ratios, why are they important? Budgeting or cash flow, why are they important? All of these determine the health of your business. So I would suggest that as 2023 starts and we kick it off, think about what your business goals need to be for 2023. They're an essential part of who you are and how you set up your company for success over that period of time. Goals ensure that you are in the right direction. So I'm saying to you, don't wait. It's November. It's the middle of November. Start planning right now so you can go right into 2023. And one other thing I want to mention too is it's important to think about not only annual goals, but quarterly goals. We call those the 90-day sprints. And we take a look at what those goals are, and then we then look at them on a monthly basis to measure against our 90-day sprints, and then our 90-day sprints against your annual goals. Having all of this together can build a beautiful, very successful, ultimately profitable business for you. So if you're still undecided and you want to start planning for 2023, we can help you create that plan that I talked about, that cash forecast, those 90-day sprints. We can help you come up with those key ratios and how to read financial statements. Again, I'm not going to make you an accountant or CPA. That's what we do. But it will help you make you more adept at understanding what they mean. I talk to a lot of business owners. They really don't understand what all the balance sheet means, what the income statement means, the cash flow statement. All of those play an important key into the success of your business. So our services, we do provide each of these. You see these here, and most of these have been covered in this presentation. One thing I want to mention is that we do offer the 4 points of focus. That is a strategic planning methodology that we use. It's our unique selling proposition. We do this, it's very unique from everyone else doing it in our industry, and we take a very holistic approach on your business so that you then cover the different areas in our 4 points of focus. And I mentioned some of these. Some of those are your marketing around how do you attract the ideal customer? What does it cost you to do it? Another is the accounting. We went over the profit first, as well as our cash flow methodology. We have an operations piece that we look at. Do you understand what standard operating procedures are? Do you know that you have your processes in a rinse and repeat? And so therefore, the more you are efficient with your operations, the more profitable you're going to be. And then the last piece is that trust in your employees. Do you have that right person? Are they in the right seat? And are they an engaged team? So that is our 4 points of focus. We look at your company on a holistic basis. So I want to thank you for being with us today. And we'll go over to questions, Shai. And for any of you that want to reach out to me, I offer a 30-minute free complimentary advice, whatever you want to talk about for those 30 minutes. I'm more than happy to be here to help you grow your business. That is my number one thing. It's my why. It's why I created North Star Strategic Partners, is to help business owners such as yourself excel and find your North Star so that you can reach the maximum capacity that you should be. So Shai, is there any questions?
Yes, Wendy, we received quite a few questions. So
Okay.
first one is, if forecasting or budgeting is dynamic, how often can we stick to what we originally projected, and what is the impact of changing the numbers multiple times?
Great question. Well, that's why we call it a forecast. So that means that it can be changed as the conditions of the business change. So at a minimum, I would say that you would want to do it monthly. More realistically, it's probably going to be more of a quarterly analysis when we do those 90-day sprints that we talked about. I would recommend starting out quarterly, but if you know you're going to have a certain situation within that particular quarter, then go ahead and adjust it as necessary. It's supposed to be dynamic. Thank you for that question.
Awesome. Number one, so you mentioned that there are 3 ratios. So earlier you mentioned the working capital ratio, gross profit margin, and net profit margin. Does NSP or North Star help with identifying other ratios apart from those 3?
Oh, great question. The answer is yes, we do. And it really kind of depends on the industry and also what exactly the business owner is trying to accomplish. But I can think of a couple already off the top of my head that I think are very crucial for any business owner. It doesn't matter what industry you're in. The first one is what we call the CAC, or the customer acquisition cost. So in other words, that one measures how much does it cost you in terms of advertising and sales and marketing to acquire a new customer. So that's very important. And a second one that's kind of related to that, and we use the data from the CAC, and that's the LTV, the lifetime value of a customer. So how long does that customer stay with you over a period of time? So as we all know, it's easier to sell to our current customers than to new customers, and it takes a lot less effort because they already have confidence in us and the trust. So when you think about LTV, and if you have a business that's transactional, versus recurring revenue, the transactional is probably a little bit harder to have an LTV that's a long period of time. However, with a subscription based or recurring revenue stream, that LTV is very important and it should be lasting over a longer period of time. The longer it lasts, the more valuable your company is going to be in terms of multiples when you're ready to pass that on to either your family, to your employees, or to an ultimate buyer or strategic partner.
Awesome. Thank you. And the last question that we have for now, Wendy, is this. I just opened a new business and I need to make sure my financials and processes are in place before making a decision. Can Northstar help me understand my financials and review my processes? If so, what are the next steps?
Great question. And I suspect there are going to be quite a few businesses starting this year and early next year because of some of the layoffs that are occurring. I think some of the younger generation will be venturing into being startups and business owners, which I'm very happy about that. So the question really is, I think, where you are. So if you're at a startup, I would do some of the smaller steps. So in other words, I would try to get my understanding around the financial statements first. What does that mean? Get my cash forecast in place. Then as you start moving, if you're a solopreneur, you're going to need less processes than if you have 2 or 3 or 4 employees. That's where you're going to need more process. But the idea behind a standard operating procedure is that it's a rinse and repeat. It's a rinse and repeat. So in other words, if you were to step out and take a vacation, someone else could step in and do exactly the same thing you were doing. That's so very important, no matter really what size company. But I think it's probably more challenging for the startups, but they could start very small and start documenting things. I probably would start with my balance sheet and how I manage all of my finances with my accounting, my back office, and then probably address my sales and marketing. I hope that answered that question.
That is the perfect answer, Wendy. Thank you so much. And those are the questions that we had for today.
Okay, great. Well, thank you so much. Thank you, everyone, for being here today. We know how time is very valuable for everyone. Spending this half an hour with me has been a pleasure, and I'm humbled by you being here. If there's anything that I can do to help you in your journey with your business, growing it, setting it up, to scale, we are all here to help you move forward. Again, thank you and all the best to you. We appreciate you. Thank you. Bye-bye.